Welcome to the Community Financial Empowerment Certification Program Level 2 certification class on credit. My name is Joseph Cecil, and I'm the Financial Empowerment Coordinator for the Office of Resilience and Community Services. And one of the programs that I get to coordinate is the Community Financial Empowerment Certification Program. Today, we will be going through what is credit and how to manage and build one's credit. So I always like to start off with a little comedy if I can. For instance, my credit score is low, but it's because I want to protect myself from identity theft. No one can take out a mortgage in my name if I can't even take out a mortgage in my own name. So just some stats and facts to get us started. Today, more than 70% of Americans have at least one credit card, and the typical borrower who has debt carries nearly $10,000 in credit card debt. Currently, one half of all consumers have subprime scores, and tens of millions more are outside the credit mainstream because of thin or non-existent files. Each year, U.S. consumers borrow around $90 billion in small dollar short-term loans. And what's amazing is credit cards weren't even in existence until the 1950s and were not widespread until the 1980s. So what does credit mean? It can have a few different definitions. Credit can mean a product like a loan or a credit card. It can mean your record of paying back your loans and credit card bills on time. But at the end of the day, the definition of credit is taking out money now and paying it back later. People many times associate debt and credit together. But there's a difference. Credit is your ability to take out money, and debt is that money you owe. So there's an old Sears catalog from 1910 that plainly says buying on credit is folly, or in modern terms, foolish. You ever wondered what the JC stands for in JC Penney? It was named for the founder, James Cash Penney, who never allowed credit to be offered in any of his stores while he was alive. It was only after his death that credit cards and store credit became a part of the business. Henry Ford hated debt so much that he didn't allow the use of credit at Ford Motor Company until a decade after the other car makers were already making loans. In 1950, Frank McNamara changed the whole financial landscape with a little piece of plastic called the Diners Club card. He had made deals with several restaurants in New York City who all agreed to accept this single form of payment across all the different businesses as a convenience to those consumers. Thus, the credit card was born. A few years later, in 1958, a little bank on the West Coast at the time, called Bank of America, sent a mailing out to about 60,000 of their consumers that contained a similar piece of plastic called the Bank AmeriCard. That same year, a new company emerged to help consumers make easy payments, and American Express was born. Credit cards started popping up more often, and in 1976, Bank AmeriCard changed its name to what we know today as Visa. A decade later, in 1986, Sears got into a big dispute with Visa, which resulted in Sears branching out and taking Visa on head-to-head with their new card, which we know as Discover. Credit practically didn't exist as we know it just 50 years ago. Can you imagine that in 1970, only about 15% of Americans had a credit card? Today, 77% of all adults have at least one card, and the average cardholder has more than 7. Right now, 1 in 10 US adults are what is called credit invisible. That means that 26 million consumers don't have a credit history with one of the credit reporting companies. An additional 19.5 million have unscorable files, either too thin or with insufficient history, or they do not have any recent credit history. In sum, there are roughly 45 million people who may be denied access to credit because they don't have credit records that can be scored. This means that nearly 20% of the US population is struggling to access financial services that many of us may take for granted. While many factors prevent these people from interacting with traditional banks, one significant obstacle can be the lack of a credit profile. But this is where they can be faced with a catch-22. Without a credit profile, they can't access credit products. But without access to credit products, they can't build a credit profile. So what are some basic terms to know? The principal, that's the amount of money you borrow. So however much in terms of a loan you're taking out, like a $150,000 home loan, the principal is $150,000. The creditor or lender, very simply, is the person or business loaning you money. And the term is the amount of time you have to pay back what you have borrowed. Most mortgages are either 15 or 30-year terms. Interest. This is the price you pay to borrow money. It's often quoted as the percentage of the loan that is added to the amount you owe each month while borrowing the principal. This is the primary way creditors make money on credit products. For instance, if I loaned you $500 and in a couple months you gave me back that $500, what did I make? Nothing. I made a friend. But if I loaned you $500 on 10% interest and it took you a couple months to pay me back, I'm going to make a little bit of money off that. A fixed interest rate stays the same for as long as you have the loan. You'll really only find fixed interest rates on loans. Variable can change based on a predetermined schedule or circumstance. This is primarily credit cards and adjustable rate mortgages. You're going to have a grace period on credit card payments before the interest kicks in, and this is usually 14 to 21 days from when you receive your bill to when payment is due. APR, annual percentage rate. This is how lenders calculate and explain the yearly cost of a loan. This is derived from things such as the finance charge, how much you've taken out, and the payment schedule, as a mathematical formula that expresses the cost of credit at a yearly rate. That percentage includes fees such as late payments, balance transfers, and cash advances. It can also include the interest rate, closing costs, and other things like that. Many people confuse it for the interest rate because they are both expressed as percentages. Beware of this new trend of the 0% card. This is where a credit card company will offer you a 0% interest rate if you switch over to them. This is especially a tactic companies will use on consumers who have credit card debt, as you will want to move that outstanding balance to a card with no interest hit. The problems are, the 0% rate usually only applies to what you transfer over, and any new purchases you make can get hit with a normal interest rate. If you miss a payment, they will throw the regular interest rate on everything, including that balance you transferred over. And this can also cause a dangerous mindset of forgetting about that balance that's sitting there. So there are two main types of credit: installment and revolving. Installment is where you are approved for a specific loan amount for a specific period of time. You pay back the total amount of the loan over that period of time. It is very concrete and very structured and doesn't often change unless you decide to change it. These are primarily loans. Now, revolving credit is where you are approved for a credit limit and you can borrow any amount up to that credit limit. What you pay back each month depends on how much you borrowed during that month. Your credit limit revolves back to its full amount each month. A credit card is a great example of what revolving credit is. Now, there are also two subtypes of credit that go hand in hand with installment and revolving, and that is secured and unsecured. A secured line of credit means there's another asset, like your car or your house, pledged against that loan or line of credit. The pledged asset is called collateral, and if you do not pay back that line of credit as you agreed to, the lender can collect the collateral. We've all heard about homes being foreclosed on and cars being repoed. Unsecured means there is no asset or collateral pledged against that line of credit. Basically, it's just your goodwill and word to pay it back. And these are things like personal loans and credit cards. If you never pay back your credit card, they're not going to come take your car or home. So then that leaves the question: are all credit cards unsecured? No, because a new product in recent years has been the secured credit card. How it works is the consumer and creditor agree to a credit limit amount, usually between $200 and $2,000. The term on it is also usually between 12 and 18 months. The consumer deposits that amount in a savings account that neither the creditor nor the consumer touch while the card is active. That amount deposited is the spending limit on that issued credit card. When the card is closed, if there's a balance still to be paid, the consumer has agreed to have the card paid off through that money set aside. If the consumer maxes the card out and never pays it off, the creditor has not lost a cent. The consumer is returned the full amount set aside when the card is closed and there is no balance. It is a no-risk product on those with no credit or bad credit, and like I said, usually lasts 12 to 18 months. No risk in terms of the financial institution or creditor. So then, after everything I've just discussed, what type of credit is a student loan? Everything about it screams installment, right? It's a loan. We have 10 years to pay it back from when we graduate. We have a set payment schedule. Screams loan, an installment. We take out a set amount for a set amount of payback time with set payments each month. But what do we actually pledge against it? At the current time and place, they don't come take your degree off the wall if you don't pay back your student loans. They haven't found a way yet to come take the knowledge out of your head. I know they're working on it. So it's unsecured, right? Like a revolving product. That's also wrong. Non-payment, though, can lead to garnishment of tax returns, wages, or anything that they can get their hands on. A student loan is a secured line of credit. It's just not for the normal means of secured line of credit. They're not going to come take your degree, but they will get their money somehow. A new innovative product out there is called the Credit Builder Loan. You agree to a principal and a term with a financial institution. Normally, it is between $500 and $2,000 and between 12 and 24 months. You make payments to them according to the term and a pre-agreed payment schedule. If you complete the payment schedule, the whole amount you borrowed is returned to you in the form of a certificate of deposit. You've actually been doing nothing more than saving money, but the financial institution has been reporting these deposits as loan payments to the credit bureaus the whole time due to the contract and terms you signed on to. You can find out what local institutions are offering this product just by typing in Credit Builder Loan. It is a very ingenious and innovative way to help someone build their credit while also saving money. So the credit industry has three main players. There's you, the consumer, who borrows money and uses credit products. There are the creditors, who use credit scores to determine which consumers they will loan money and offer credit products to. And there are the credit bureaus, who collect consumers' credit information and store it. So multiple choice. What type of organization are the credit bureaus? Are they A, run by the federal government, B, run by the financial institutions, or C, private businesses? Take a second and formulate a guess. All right, let's see if you were right. The correct answer is they are C, private businesses. So what are their names? There's Experian, which was created in 1968. Equifax, headquartered in Atlanta and created in 1899. And TransUnion, headquartered in Chicago and created in 1968. The big three, Experian, Equifax, and TransUnion. They maintain credit reports and create credit scores. They own the patent for the credit score formula. Credit bureaus, though, only collect and report information. The credit decisions are made by the creditors. And I'm assuming if you're watching this, you've received a pre-approved credit card in the mail. Well, unfortunately, that was not by accident or random chance. Creditors, lenders, and financial institutions can contact the credit bureaus and request and pay for the addresses for people within certain zip codes with a credit score above or below a certain number. And the credit bureaus can legally sell your information to these creditors. And then you end up with a pre-approved credit card in the mail. In 2017, the three major credit bureaus collectively earned $4 billion. But are there others? There are more than 400 regional or industry specific credit bureaus in the US. There are about 40 alternative credit bureaus that specialize in things such as rental history, medical records, and employment history, among others. Altogether, credit bureaus make an estimated 36 billion updates using data every year. So who is checking credit? And this is just a short list. Anything with housing, people applying for mortgages or applying to rent apartments. Transportation, those preparing to buy a car, getting car insurance, even renting cars. They may not do a credit check, but they're going to want a credit card. Employers, many employers are turning to credit checks to test reliability and responsibility. A recent study found that 47% of employers include a credit check as part of their application process. Something important is you have to be informed that they are doing a credit check as part of the application process, but they do not have to inform you whether what they saw on your credit report factored into their decision whether to hire you or not. Some cell phone carriers are now doing credit checks, which can affect your bill, how much you have to deposit, and even what phone you can get. Utility companies, it can impact your rates, and credit can access and affect your future financial decisions. It can either help or hurt your ability to access other lines of credit and what kind of fees and rates you get. There are creditors out there who will report a missed payment to the credit bureaus, but meanwhile have not reported your string of on-time payments. Landlords, utility companies, rent-to-own companies. These people will not report 2 years of on-time payments, but will not hesitate to report that one missed payment. And you get hit with that negative missed payment on your credit report. Credit Builders Alliance is an organization that helps to fight these issues. CBA's platform primarily focuses around offering services and helping small lenders report information to the credit bureaus and helping partners pool and disseminate credit reports. They support practitioners through training and professional development opportunities. They promote the replication and sale of safe and responsible credit building products and strategies. Every CBA service and task is performed in the pursuit of a unified objective to increase the capacity of nonprofits to effectively support low and moderate income clients in building credit. Most institutions that the CBA works with are community development financial institutions. These small lenders work in communities to provide services, including loans, to people who otherwise wouldn't be able to access them. They have 526 members, and credit extended by these members has totaled over $2.5 billion. They have assisted us here in the Louisville area. They provided technical assistance for the Bank on Louisville Credit as an Asset curriculum and assisted our micro business program in getting loan payments reported to the credit bureaus. So let's talk about what are some benefits of good credit. But one is it can save you money. You see here on this auto loan, bad credit has a 17% interest rate and about a $250 monthly payment, whereas great credit has a 14% drop on that interest rate and about $70 cheaper monthly payment. On this mortgage, bad credit is not even getting in the door. Okay credit, it's got a 5.6% interest rate, but look at great credit. You're down 1.6% interest rate, which is massive on a $100,000 principal, and your monthly payment is nearly $200 cheaper. So having good credit, great credit can help save you money. You can see here how the FICO score on a home loan impacts the average interest rate. You see we start here at 6% for the great range, and as we get into bad, we're jacking that up close to 10%. The difference between the best and worst means you will pay $360 less a month on a $150,000 mortgage, which equates to roughly $4,400 saved a year. Good credit can also improve your access to other high-quality financial products and other lines of credit. But one of my favorite things it can do is it can help you buffer economic shocks and emergencies. I never advocate maxing out a credit card, but in an emergency, it is great to have a piece of plastic in your wallet with a couple $1,000 credit limit. Credit building. This is the process of establishing and maintaining a credit history. You build your credit when you have positive active lines of credit, also called trade lines, on your credit report. You build your credit when you make on-time monthly payments on a financial product such as a loan or a credit card, which are reported to those credit bureaus. Another way to help build credit is through authorized users. An authorized user is someone who is allowed to use someone else's credit card. The person who owns the credit account is the primary card holder. The authorized user may be issued their own credit card, but the account still belongs to the primary card holder. A major incentive to being an authorized user is piggybacking off the primary card holder's good credit habits to increase their credit score. This can also work both ways. If the authorized user does not use the card responsibly, that can damage the primary card holder's credit. So what are some ways we talk about building credit? What are some ways to destroy your credit? Credit cards are a fast and convenient way to spend money, which makes them one of the easiest ways to get into debt. The average U.S. household has $7,200 in credit card debt. Those that carry a balance, most recent studies showed they owe about $15,000. Students who graduate with no real repayment plan in place for their student loans can start off with negative credit histories. You miss payments. You use up all of your available credit on a credit card, aka maxing out. If you don't have any credit, that can be especially detrimental to your financial situation. And if you open up too much credit, especially in a short period of time, all these things can have negative impacts on your credit. Co-signing is a definite troublesome area. This is where someone trying to access credit needs the backing of someone with good credit in order to access the product, because the applicant has poor or no credit. The co-signer is basically agreeing to be a responsible party if the applicant does not pay back the loan or the credit card. This is extremely risky for the co-signer, whose credit will be impacted and can be left covering for someone else's financial mismanagement. Like to say in terms of co-signing, there's a reason they need a co-signer. Keep that in mind. Credit building is not the same as credit repair, although they are related. Credit repair focuses on resolving errors on your credit report, paying off debt that is in collections, and reducing active debt balances from becoming delinquent. Beware of the credit repair companies. These businesses claim they'll fix your credit for you. We've all seen them advertised on street corners. In reality, all they do is dispute everything on your credit report, whether it should be there or not, in hopes their influx of disputes causes the bureaus not to get back to them within the required 30 days by law. They file the majority of these disputes during what time of the year? Well, that's the holidays, when the bureaus are least staffed. Some companies will even collect a monthly fee from you that includes your normal monthly payment to your creditors. Let's say $500 plus a fee that they charge you for the service, like $50. Although they collect the $550 each month, they may not be passing the $500 total onto your creditors, because what's their incentive to help you get paid off any sooner? They're going to lose that monthly fee. Credit repair process may involve settlements with debt collectors and those creditors you owe money to. You may also consolidate all your debt into one account and make a single payment that is then dispersed to your various creditors. The last step, and one you should only take if you need to, is declaring bankruptcy. Bankruptcy allows you to wipe out all unsecured debt, but your credit history will be damaged for up to 10 years. So let's talk about credit reports. You get one free report per year from each of the three bureaus. Information should be roughly the same on all three reports, and this is not a clock that starts January 1st and ends December 31st. It is a clock that starts when you pull that credit report from that bureau. So if you pull Experian in January, it just means you cannot pull Experian again until January of the next year. There are three ways to request your credit report. The most common is this website here, annualcreditreport.com. Please only go to that specific website. If you type free credit report into Google, you may go to 1,000 different websites that are not this one set up by the federal government, and each of those other websites is going to want you to pay. You can also call to get it mailed to you, or you can send a written request. If you go through annualcreditreport.com, you will download them as a PDF. Please know your credit report is not a complete history of your use of credit. It is a 7-year snapshot in time. As you close credit products, they will rotate off of your credit report within 7 years of the closing date. Chapter 7 bankruptcies stay on your credit report for 10 years. Tax liens stay on your credit report for 7 more years after you pay them off, and so do civil lawsuits and judgments. A credit report is a detailed summary of your bill paying history and the current status of your credit accounts. It documents who you owed, how much you paid, and whether or not you paid on time. Potential lenders use this information to evaluate their risk of extending you credit. Each credit report has 4 basic categories we'll go over: identity, existing credit information, public records, and recent inquiries. You can also get free additional credit reports during a year for any of these situations. You're unemployed and plan to look for a job in the next 60 days. You receive public assistance. You believe your credit file is inaccurate due to fraud. You've been denied things because of the information in your credit report. So when to request your credit? Anytime you're considering a major purchase that will require a loan, make sure everything is there that's supposed to be there. Another is to see if you've been the victim of identity theft. Just regularly to check to see if there are any errors. And applying for a job is a good reason to review your credit report. You can also check to see if recent actions or tactics have shown up. So here's what a sample credit report looks like if you download it. This information here where it says the name and employment, this is the identification section. And down here where it says public record, that is where we mention those civil lawsuits and judgments. So your identifying information or header should include your name and aliases. Aliases just mean a change of your name officially. A current address, your social security number, and it should have some employment history. It may not be entirely, but it should have some, and you need to make sure what's there is accurate. What it should not have is any information on race or ethnicity. Public record is a financial public record information such as bankruptcies, judgments, or tax liens. What it should not include are arrests or convictions that are not related to that, marriage records or adoptions, or civil suits that didn't result in judgments. Now here's the meat or bulk of the credit report. We've got collections, trades, and inquiries. Collections stay on your credit report until they are resolved, and once closed, then the 7-year clock starts. It is important to understand the last time the collections account was verified with the bureaus, which means someone reported they were still actively seeking money for that account. If an account is not verified for 7 years, you have the right to have it removed from your credit report. Remember, though, the actual debt itself does not disappear, and you still do owe someone money somewhere. I also cannot get a clear answer on double jeopardy, which means if a collections account rolls off because it was not verified in 7 years, if someone new buys that debt and reports they're looking for it, can it rotate back onto your credit report and be damaging again? Because I cannot get a clear answer, it makes me think the answer is unfortunately yes, they can reappear. Trades are open accounts you currently have or closed accounts that have not rotated off yet. They should include this basic set of information: company name and account number, the balance you took out, what the last payment was, terms and number of payments late. Inquiries, there are 2 types: the hits, the checks. A hard hit means you are looking to access credit. This is typically a couple point hit on your credit score. These are financial institutions, credit card companies, car lots. You are looking to take out credit. Now you may think then, well, I'm about to go car shopping. That means I can't go comparison shopping. I can't go to 4 or 5 separate places because I'm going to lose all those points. Incorrect. By law, you are allowed to comparison shop. The credit bureaus are supposed to notice if you're getting a similar amount of inquiries in a short period of time. They're supposed to collectively term those as one credit check. It's usually between 14 and 21 days is the window you have. I would always contact them anyway to let them know you're about to go car shopping or to get a mortgage. That way they have no excuse for not collectively terming them as one. Now, soft hits have nothing to do with accessing credit and do not impact your credit at all. You checking your credit has no impact. Employers, cell phone companies, utility companies, they don't have an impact. So aren't you afraid of inaccuracies on your credit report? Actually, I'm more afraid of the accuracies. That's because, according to the Federal Trade Commission, 25% of all credit reports contain errors or incorrect information. Some are harmless, such as misspelled names or addresses, but some may signal identity theft or have a serious impact on your ability to access other lines of credit. Some errors can even include someone else's credit being placed on your credit. And whose job is it to spot these errors? Unfortunately, it's ours. To dispute information you believe is incorrect, the best way to do it is in writing to the credit bureaus, though they also have links to do so through their websites. Be clear and concise. Tell your story and use information that is relevant. Provide as much documentation as you can, but make sure they're copies. Never send originals. Send your dispute letter by certified mail to one or all of the bureaus. Certified mail lets you know when that receiver has received that piece of mail, so you know when that 30-day window starts. Make and keep copies of your correspondence just in case. And remember, they have that 30-day window to get back to you, and if they do not get back to you within that 30-day window, you can say, I want it automatically taken off my credit report. So here are 3 things that have something in common that you may not know: the FICO credit score, the KFC recipe, and the Coca-Cola formula. One of our financial institution representatives we work with the Bank on Louisville program has a great quote about that. He goes, there are 3 things I'll never see in my lifetime or have access to: the FICO credit score formula, the KFC herbs and spices, and the Coca-Cola recipe. Why? Because they are all protected, patented, and under lock and key. There is far more than just one credit score formula out there, but the most widely known and used are the FICO score and the Vantage score. So what does FICO stand for? It is the Fair Isaac Corporation. A credit score is the easiest way for most traditional lenders to determine who may qualify for their credit and at what rates. It shows reliability and responsibility to them. The scores generally range from 300 to 850, with a higher score meaning you're a lower risk. There's even a new Ultra FICO you can opt into that looks at your bank accounts to see if you have a good track record of avoiding overdrafts. The way the business world sees it, your FICO score is a great tool to size up how good you will be at handling new credit, or whether you're a solid citizen to rent an apartment to. Your score is based on your spending and bill paying habits and your overall amount of debt. Your score is used just like colleges use SAT or ACT scores. It's your financial life reduced to 3 digits. Anything between 300 and 500 means you're a toxic risk, and you're going to be hard-pressed to find businesses that will work with you. Scores between 500 and 850 are sliced and diced to fall into 6 ranges, but the exact cutoffs for those ranges vary depending on the lender. Other factors like current income, how much debt you have, and how stable your employment has been can also influence credit decisions. Your scores vary depending on your recent credit activity. The credit bureaus only calculate your score when it is requested. So any score they calculate will be based on the information in your file at that moment in time. And what do you think the median FICO score is? I'll give you a second to come up with a number. Remember, it's between 300 and 850. Take a second to come up with a number. It is 720. That same financial institution representative has a great metaphor for your credit score. Think of it as going on a road trip. You have bad credit, you got left at home. You're dangerous behind the wheel of that car, and you're dangerous with a credit card in your hand. you're gonna struggle at times to get access to credit, and you're not gonna have great rates or terms. If you have good credit, usually between 620 and 780, you're in the car, but you're not driving. You're going to get access to credit products, but you're not really going to be able to dictate terms and conditions. You've got super prime, great credit, 780 or above, you're driving the car. Creditors want to work with you because you pay back what you owe. So most credit scores take the following factors into account. In terms of the impact, I can say it again, the most impactful thing in building up your credit is a history of regular on-time payments. That is the most impactful thing you can do to impact your credit. They also look at how much of your current available credit you're using in terms of credit cards. It's a fancy term called credit utilization ratio. Try not to spend more than 30% of your credit limit. So if you have a $1,000 credit card, try not to spend more than $300 on it every month. If you go above that, creditors think you might be a little too reliant on that line of credit. They also want to see a length of your credit history and how you've been able to handle that line of credit over time. They want to see a mix of credit and hard hits impact your credit, like I said, a couple points each time. Unfortunately, there is no annualcreditreport.com for your credit score, and if you remember back to that sample credit report, there was not a score listed on there. You can request your credit score from FICO, but you're going to get charged $19.95 for every request. I always get asked, what about Credit Karma? It's all right if you use the free version, but you only have 2 of the 3 credit bureau scores. Your credit score is the average of the 3 scores. But your final score you're missing should not be 20 points higher or lower than what you see. But the problem is any credit score you see is not what is pulled by the creditors. Creditors can request your score be weighed differently when they pull your credit. So if the generic formula is 50% how you've used credit cards in the past and 50% how you paid back loans, they can request that formula be altered based off what kind of credit you are requesting. This usually results in a lower score, unfortunately, though that is not their intention. So how do you find out your score? Typically, a lender will check just one of your FICO scores, so you may want to call before you apply and find out which one. They say Beacon, that's Equifax, Empirica is TransUnion, and Thankful for Simplicity, Experian is Experian. Mortgage lenders are going to pull all 3. So tips for maintaining good credit. As I cannot say it enough. There's nothing more impactful on your credit than making an on-time monthly payment and building a track record of it. Again, try not to use more than 30% of that available credit limit. And don't close old accounts in good standing if you don't need to. The minute you close an old but positive credit card for a new flashy offer, you start that 7-year clock on when that positive line of credit disappears. As much as it doesn't make common sense, do not pay off lines of credit when you get a windfall. Your credit report doesn't factor in income changes or windfalls, so it looks bad if you pay off a line of credit extremely early. All they see is you needed this car loan, all of a sudden you paid it off in 3 months, apparently you didn't need it, and that looks bad to them. Try to maintain a mix of active trade lines, both installment and revolving. It's recommended to only have 3 to 5 active lines of credit with no more than 1 to 3 of those being credit cards. Creditors want to see a mix to understand how you use those different types of credit and can fully evaluate you. And use credit cards for something you already pay for in your budget. That way you already have the money. People can get into trouble with credit cards when we use it on something we don't already pay for, we don't have the money for. Don't apply for a lot of credit in a short period of time unless it's for a specific asset, as I mentioned. It makes you look desperate and unorganized, and those are traits the credit industry does not want to see. Don't carry a balance on a credit card unless you absolutely have to. This is an old wives' tale I've heard, that in order to build credit, you have to carry a balance. It's false. Just remember what that most impactful action is for your credit. Beware of the promotional offers from chain stores and credit vendors, because signing it up means opening up a line of credit. A store card is a credit card and a predatory one at that. They usually offer them around the holidays with massive discounts, but they're hoping you're tapped out by the holidays and can't afford to pay off that month. Then the interest kicks in. Also think, will you really need that store card after the holidays? If you do decide to start canceling multiple credit cards, it is recommended to cancel just one at a time. Give it at least a month to be picked up by the bureaus and maybe use something like Credit Karma to see how it affects your score. Then start staggering your closings over the next months. Do not close them all at once. That looks very rash. Always cancel the newest card first because it has the least amount of track record, but make sure it has at least 8 months of good, positive information first. A newer service out there are Credit Boost. The idea is to help thin file consumers by incorporating signs of responsible financial behavior that traditionally aren't seen. Boost also may help people who are rebuilding their credit. Experian estimates their product could affect up to 100 million consumer scores. Consumers who want to use Boost must allow the product to scan their bank account for transactions to utility and cell phone companies, and only the positive payments will be reported. So again, I mentioned credit doesn't make common sense. Let's say you take out a $5,000 car loan. Let's say 3 months later you hit a scratch-off ticket for 20 grand. Common sense says you do what with the money? Well, we pay off that car loan, right? Credit common sense says we do what with the money? Well, it says we start making more than our minimum payment every month and get it paid off sooner, but not tremendously sooner, because again, that looks bad. They don't know about, credit bureaus do not know about this windfall you've gotten. If you suspect identity theft, follow these steps. Call the companies where the fraud occurred and pause or cancel your accounts. Report the theft to the Federal Trade Commission, FTC. Place a fraud alert on your credit report. You can also place a security freeze, which prevents any new credit accounts being opened until you lift it. There are kind of 5 C's of credit. There's your character, which is your ability to keep your word, aka your payment history. There's your capacity, your income. There's your assets or capital. Lenders are more willing to approve loans for borrowers who have reserves and assets. There's your collateral. And there are the conditions. Conditions being kind of the overall economy and what's going on around us. No credit or credit invisible is actually worse than bad credit. At least with bad credit, people can see where your previous issues were. No credit means you are a wild card and a bigger risk. And remember, financial institutions do not like to take risks. People under the age of 18 should not have a credit profile unless their parents made them an authorized user, which means the young person basically assumes their parents' credit. If there is a credit profile for someone under the age of 18, it is likely someone used that young person's information to take out a line of credit in the young person's name. Do you know the only way to get that information off that young person's credit report? It is to file charges. That is some of the worst conversations I've had to have with young people who pull their credit report and find out someone, a family, friend, or guardian, opened up a line of credit in their name. So what would you all assume happened to the rate of credit card usage once the pandemic began? Wouldn't we think it went up, with everything going on? Experts originally expected credit card transactions to increase as consumers and storefronts opted to go cashless. And it might be easy to assume that most people are relying on credit cards to help make ends meet. But credit card usage has only captured an additional 3.4% of all in-store transactions since January 2020. According to CNBC's most recent data, credit cards now make up 82.1% of all in-store transactions, up from 78.7%. The data shows that a small percentage of people who used to use cash are now opting for credit cards to do their shopping, but please remember this is just in-store transactions. People, though, have started avoiding big purchases due to income restraints, and those purchases were often the focus of credit card usage. In fact, a new report by the Consumer Financial Protection Bureau found that applications for credit cards have dropped by 40% since the pandemic began. CNBC predicts, though, that we will see people starting to use more credit, especially as the job market continues to linger. And with changing requirements and legislation from government leadership altering who can work and who cannot, cash shortfalls will eventually need to be covered somehow. A growing preference for debit card spending should help explain why credit card usage is not higher. Additionally, the stimulus checks have provided consumers a little buffer before they've had to use credit. The CNBC article said that the fact that credit card usage has only slightly increased since the start of the pandemic is a bit surprising, and I think I agree with that. Credit card usage is not just down, but more consumers are paying off their credit card debt. In early October 2020, the Federal Reserve reported that consumer credit card debt totals fell from 1.08 trillion to 985 billion, a decrease of about 8.6%. Prior to the pandemic, 44% of consumers carried a balance, while 56% paid their bills in full every month. During the pandemic so far, 39% of consumers have been carrying a balance, and 61% have been paying off their balances in full. To put this even more plainly, in the first 5 months of the 07-08 recession, total credit card debt increased by $18 billion, compared to the decrease of $104 billion in credit card debt between February 2020 and July 2020. So there's been some positive. Lenders are also offering low-rate, small-dollar loans and options to defer payments in response to the COVID-19 crisis. These are known collectively as hardship assistance. While some personal lenders have tightened approval requirements, others have introduced low-rate, small-dollar loans to consumers dealing with financial hardships. Some lenders are offering help like deferred payments and waived late fees as well. Banks, though, across the board tend to be tightening their lending standards, which shrink the availability of credit. Student loans have suspended loan payments and set interest rates at 0% for 60 days. So does anyone know the Dave Ramsey take on credit? Well, if you can't pay cash, you don't buy it. According to him, the FICO score has nothing to do with wealth and success, but is an I love debt score. When you open a credit card account, you're likely to pay thousands of dollars in interest over the years as you build up a balance. There's no good reason at all to have a credit card, according to Dave Ramsey. Despite what commercial, celebrity spokespeople, and the Joneses next door tell you, responsible use of a credit card really doesn't exist. To him, there's no such thing as credit card rewards. Credit cards enable people to go into debt faster than ever before, according to him. So I like to say real quick in terms of Dave Ramsey, I love his financial philosophy on pretty much everything but credit. I think today's world, as I mentioned that short list of people checking credit, credit is so intertwined in a lot of our daily life now that it's a necessary skill to have. So that is one place where I do disagree with Dave Ramsey. So what are some resources out there? Bank on Louisville has the Credit as an Asset curriculum. It is an introduction to credit and how to build one's credit. There are monthly classes open virtually to the public, and we can train people to utilize it within their organizations. For more information on that, there is my phone number and my email address. Apprizin are certified financial counselors and debt management services. They are fantastic. L-Home offer a variety of sustainable loans for small business, employment, and home repair. The CFPB has a credit booklet and a Your Money, Your Goals module on it, as well as the FDIC has a Money Smart module on credit. So if you do have questions, you can reach out to me at joseph.cecil, C-E-C-I-L, at louisvilleky.gov for not just this presentation, but for anything concerning the Community Financial Empowerment Certification Program as a whole. Again, that is joseph.cecil at louisvilleky.gov or 502-574-1969. Thank you for watching and attending this training today on credit.